Hi, everyone, and welcome to Leaders in Lending. I am Lynn Sautter Beal, and I'm joining you today from CBA Live with Joseph Mayans from Experian. Joseph, do you want to talk a little bit about your background and your role as Chief Economist at Experian?
Yeah, thank you, Lynn, and thank you for having me back. So yeah, I'm the Chief Economist at Experian North America. So just roughly what I do, I spend probably about 70% of my time doing external work with our clients and our partners. Give a lot of presentations, speak with probably 120 organizations a year, all across kind of the financial system ecosystem, from the largest banks to fintechs, credit unions. I also spend the rest of my time, I report up to the North America strategy team. And so I also do a lot of work working internally with our strategic finance, our finance team, strategy team, thinking about kind of those major pivots in the economy that may be material for our business as well.
Well, great. Well, I know we did this conversation last year, so it's great to have you back on the podcast. I think heading into year end, felt that the economy was maybe a little more resilient than expected, and that near-term recession concerns were starting to ease. But now I think we're certainly seeing some more uncertainty increase, and especially with different things going on in the world. So, what indicators are you watching that could signal shifts as we kind of move into 2025?
Yeah, so I think there's a couple things. So you're absolutely right. When we coming out of 2024, the economy really had solid momentum. Overall economic activity was doing really well. Labor market pretty solid, spending pretty solid. But there were some trends, and I can talk about them in a little bit. There were some trends that gave some kind of a heads up that we may be entering a little bit of a slower period. And then on top of that, then we got hit with we have a lot of obviously policy uncertainty coming out of DC. Some of that further perpetuates some of the slowing trends that we did see. But overall, you're right, solid momentum. So what I'm really looking at right now, I think there's a couple ways to think about it. So top of mind for me at the moment is everything that's going on with trade and tariff policy. And so really I think about it as kind of affecting two different channels. One you have the kind of the inflationary aspect, the impact that it's going to have on the Fed. I think we can hit on that too. But definitely I think higher tariffs are likely to lead to higher prices. One of the questions is how long and how persistent those price changes may be. But either way, it's probably going to cause the Fed to be more cautious in the short run. But what I'm honestly a little more concerned at the moment is kind of the uncertainty that this is driving in the broader economy, especially for things like business investment and consumer spending. So that's actually a segment that I'm a little more concerned about at the moment than even the inflationary impacts.
Yeah. Do you do you think going into kind of what we're seeing, this like persistent inflation and higher for longer rates? Do you think the Fed has really the right tools to kind of balance the growth and stability? Like, do they have enough kind of dry powder to influence according to their mandate?
So the Fed is stuck. They're stuck in a little bit between a rock and a hard place at the moment, just because inflation was already proving to be more stubborn than they would like to see, even coming into the end of 2024. And now you look at the tariffs, definitely. If it doesn't drive inflation higher, it's at least going to keep inflation where it is, which is above the Fed's target, I think, for longer. I think the Fed does have tools. Obviously, they have room in the federal funds rate to drop it fairly substantially if they need to. But it's definitely going to be a challenge. And I do think that this year they may have to make that choice. If push comes to shove, what are you going to support? You're going to try to make sure you keep inflation under control, or are you going to try to support the labor market? My personal view is that they'll support the labor market. So.
Interesting. Yeah, I think that certainly policy uncertainty and political changes are having a big impact. And I'm a big Twitter fan and Reddit fan as well. And I think everyone's an expert on tariffs right now after being experts in other things earlier this year. So, as you think about building forecasts for 2025 with so much uncertainty happening, and particularly like regulatory uncertainty and policy uncertainty, how do you think about factoring that into your forecasts of what you are projecting at Experian?
Yeah, so it is very difficult at the moment when you look at kind of I don't think you can just pick out one policy aspect at a time, whether it's just tariffs or immigration or spending cuts or tax cuts or deregulation. It's really the package deal. But how I am thinking about it is you have the short run impacts. So, we have tariffs, we're having, shifts in immigration policy, you're having, federal government layoffs, you'll have some spending cutbacks. And so I think about it really in the short term. Those things weigh heavy in the next 6 to 12 months. And then I think the tax cuts and the deregulation, those impacts will probably come later. So really when I'm looking at the forecast, I'm looking at that tariffs, job cuts, those things in the short run. And I think if you look at the short run, it's clear that it's likely going to weigh on growth, likely going to weigh on the labor market. And I do think that that's one reason why, the market in general, if you go back to December, the Fed was projecting two rate cuts this year. I actually think that's a pretty good baseline. I know recently there's been kind of a split. Some economists saying, "Oh, look, the Fed's going to be very focused on the inflationary picture because of tariffs, going to keep them cautious for longer. We may get one cut, we may get no cuts." On the other side of the thing, you look at market pricing of rate cuts this year. Now they're up to maybe like 3 cuts. My general view at the moment is if we look at that and we think about kind of the near-term risks, if I were to take a bet whether the Fed's going to cut more than twice or less than twice, I think they may cut more than twice this year. And we can talk about maybe in a little bit about some of the weaknesses, and I think in the labor market that may be showing up more readily for them.
Yeah, that definitely is going to be an interesting time, and every time I guess is unprecedented.
Yes.
But I think the one thing we've seen though is consumer spending's remained pretty strong, and even though we've seen some dips in consumer confidence, you see spending isn't reflecting that. Like, what do you think's driving that? And do you think with some of the changes to federal employees, cuts to federal agencies, do you think that that's going to then trickle down into really how consumers are spending their dollars?
Yeah, so I think there's a couple things there. When I think about the strength of the consumer, so I've been generally, when I joined you last time, I've been more optimistic over the past couple of years than most economists. And that's just because I had, conviction that the consumer was both able and willing to continue to spend. But some of those dynamics that drove me to that conviction have really been kind of fading over the past year. So one of the biggest drivers, 2023, early 2024, really strong personal income growth when adjusted for inflation, rising at a solid pace. That was really supportive of spending. What you've really seen over, especially the back half of 2024, is a softening in overall income growth. So it's now running below the average that you saw prior to the pandemic, which now gives me some pause that, how I do think consumers will spend this year, but I don't think they'll have quite as much ability to do so. But what you did see, though, in spite of even having incomes kind of fade a little bit into the back of the year, you did see spending growth remain very robust, honestly. And I think so this is kind of the second piece. One is that, again, like I said, the income I think is softening, a little more concerned about that. But the other piece is you have to think, why was it that consumers were willing to, even in the face of their income growth softening a bit, they kept up spending growth. Actually, spending growth really was very solid through 2024, and spending growth was rising faster than income growth. You can't have that happen forever. But the question is, why did that happen? In my view, it has very much to do with the net worth impact that we've seen over the past several years. Your home value goes up 40%, your 401k goes up 40%. You feel more comfortable spending a larger portion of your income every month. But what we've seen recently, and I think especially since whether you want to call this a new trade war, an extension of the prior trade war, but either way, all this uncertainty, you've definitely seen more of an impact. I think the S&P 500 had entered a correction. And I think you're seeing more people probably cognizant now, well, maybe those things that have supported my spending over the past couple of years, maybe they're not doing so well. Maybe I cut back a little more now.
Yeah, I think that's probably a good point, that if you think you're going to make more next year, and if you keep seeing your investment balances go up, you may feel a little more confident, like, yes, I'll book that trip. Yes, I'll buy that thing. Yes, I'll start this home improvement project. So as you think about then how that relates to lending in the credit environment, credit markets, I think we may have talked last year a little bit about real estate, and rates had been super low for so long, and so this idea that people weren't going to move, you're not going to sell and walk away from a 3% or 2% mortgage, and that people were going to do more home improvements, and so now that rates have increased rather substantially and seem to be pretty sticky both on the mortgage side. Where do you see the opportunities maybe for lending or the credit markets, or what may be the kind of products or asset classes that are coming into favor in the current environment?
Yeah, I think it's kind of interesting because, like we mentioned earlier, like the economy really came into 2025 in a good place. And I think you can generally say that as well when looking at the credit environment. So, you had seen really over the past since, late 2022, lending standards has tightened very substantially. Interest rates were high. But coming into the back end of 2024, lending standards were generally, at least for banks and the broader market, were still tightening, but not tightening nearly at the pace. And you did see some loosening. Large banks loosening in autos. You saw some loosening in HELOCs. And I think what you can see, like the pickup in lending and fintechs, we don't have an exact measure of lending standard tightness for fintechs like we do with banks when the senior loan officer survey comes out. But fintechs generally tighten lending standards earlier. I think maybe got ahead of some of their delinquencies earlier. I mean, I was listening to your, like I said, your earnings call. I think your CFO said peak defaultiness was early 2024. And that's what I hear from most fintechs. So I think coming into the back end of 2024, the credit environment was stabilizing into where you had more people, more market participants starting to think, maybe I can step my toes in the water a little bit here now as we enter 2025. Obviously, the uncertainty is challenging. But what I do think about some opportunities, obviously there's a fog of uncertainty. So there's risk this year for sure. But when I think about opportunities, I think about some of the constraints that some lending segments have. Like, for instance, you can see it in the lending data of credit unions. Early on, credit unions and during the pandemic, they're a big auto lender, made a lot of auto loans. Some of those auto loans are not performing, I think, as well as they expected. And so credit unions have pulled back from that auto lending space.
Sure.
We can see it in our origination data. You can see it in the balance sheet of credit unions. And so that constraint fintechs have started moving to auto. They're not huge in there, but they're starting to move in. And like I said earlier, big banks have loosened, I think, maybe 3 quarters in a row, lending standards for autos, maybe moving a little more in there. So I think about opportunities like that, but using that kind of framework that some constraints that happened during the pandemic may open the door to other entrants this year. I think about the same thing with business lending. So my general view this year is that the uncertainty may be most impactful to business lending. And the reason why I say that is if you look in the 2018-2019 period, research shows that the rise in trade uncertainty caused banks to pull back from lending, not just to those firms that were impacted by tariffs. Like, obviously, you're going to be cautious if your manufacturer that you do business with, now their input costs gone up by 50%, are they going to be able to survive? You're not only cautious there, but they raise interest rates. So it kind of basically, in essence, just reduced the supply of lending that they were doing. But also businesses themselves pull back out of caution. But anyway, so banks pulled back in 2018, 2019, because of the prior trade war. Uncertainty now is higher than it was then. But the other things is that banks during the pandemic era, when they had all these deposits, they didn't know what to do with them. And so they bought a lot of longer dated securities, a lot of mortgage-backed securities, 10-year treasuries, those kind of things. As interest rates have risen in recent years, the bond value goes down. And so now they have large kind of unrealized losses on their balance sheets. A lot of regional banks are still working through some of the commercial real estate portfolios that aren't performing really well. And so those constraints, they're not like, I don't necessarily think them in themselves are not a risk at the moment. As long as it's more of a function of interest rates, as long as interest rates remain high, it causes, though, a little bit of additional caution on the balance sheet. Research does show that large unrealized losses, other concerns on the balance sheet will cause institutions to pull back from lending, or at least remain extra cautious in an environment of uncertainty, which is what you have now. So you have higher uncertainty now. You have some of these balance sheet challenges at banks that may make them extra cautious. At the same time, business loan delinquency is rising quite a bit faster than consumer delinquency, which again I think will cause that a little bit of a pullback. But what that means in terms of opportunity is, so like right now we're creating north of 400,000. We have north of 400,000 new business starts or filings every month. Prior to the pandemic, it's like 280,000. So a significant more new businesses are being created, and many of them are very young businesses. And so that, when I think about opportunities, fintechs, I think fintechs are moving more into that space. Lynn, have a lot of technology, a lot of data to lend to those kind of thin file new businesses. So I think, like, when I think about opportunities, I think about that. Where some maybe market participants who have some constraints coming into this year may hold back, be more cautious, and what does that open the door for other market segments?
No, I think that, we did a kind of small pilot into the small business lending space kind of early in the pandemic, and then for a variety of market reasons decided to suspend that for a period and have not kind of reopened our business lending. Yeah. But we are seeing growth in the auto space, in the auto business, particularly in refi at the moment. Certainly as you're talking about that, I was just thinking about just the sheer complexity of the global environment and even the political and economic environment just in the U.S. And as you think about, maybe the regional banks, the community banks, the smaller lenders and the credit unions, how do you, what would you suggest they do to think about just all of these different levers that are moving in the market, and how to think about managing their portfolios and managing their business strategy? Like how can they be at least most effective in understanding what may be happening out there and how it relates to their business? I think it's certainly a challenge, and so I don't know if there's a great answer.
Yeah, I don't know if there's definitely not a one size fits all. When you start zooming into community banks and credit, those organizations that operate more regionally, those are very much, obviously there's a lot of different shifts happening right now, and I think no doubt labor market is key to watch, but especially regionally. Like if you operate in the DC market, you're going to have a little more stress now, or those markets that have large concentrations of federal employees. That's definitely something to watch.
Yeah. So, we talked a little bit about fintech and the opportunities for fintechs to kind of come into some of the spaces. I think it is true that, and I've said this as somebody who used to work in banking before I worked in fintech. You don't get fired for not taking risk in a bank. It's a safe place to be, unless you're on the trading side, and then you could potentially lose your job for not taking risk. But you are incentivized to be more risk averse, and on the fintech side, you can be a little more forward. Are there any other kind of technological innovations, or maybe even changing consumer behaviors that you think that banks need to monitor closely as they're going into 2025?
Well, one area I do think. So one dynamic that's playing out in the economy right now is that really over the last year is you've seen just a general weakness in hiring. So the overall hires rate is very low, and outside the pandemic it's near a decade low. And that just means that the labor market is not fast to absorb people who are looking for work. So whether you get laid off or you're coming off the sidelines looking for work, whether you're graduating college and now you're looking for work, so on and so forth. And that lack of absorption is actually the cause of most of the rise in overall unemployment, not necessarily layoffs. So when I think about technological change, I think specifically this dynamic, this low hiring rate, is also happening a lot in the white collar, higher income segments. So you can see in the higher rate for those kind of industries. You can see in people with bachelor's degree who are moving from unemployed to employed. That rate is very, very low. And so it's okay if you have a job, not so great if you're looking for a job. So when I think technological advancement, I think about things like, okay, what's going to play out in AI? How are companies going to take this up? And then my general view this year is that we could see the hiring rate remain generally fairly low this year. And then you have companies who are cautious about the environment, maybe saying, hey, instead of hiring the software engineer, let's see what we can do with AI here. And that perpetuates, I think, that could perpetuate a kind of labor market that's not great at absorbing people. But that's problematic. That's one reason why I do think the Fed may cut more than twice this year, because they realize that in an environment that the labor market's not absorbing workers very quickly, that a large pickup in layoffs could result in a very fast uptick in unemployment.
Yeah, no, I think, and I mean, we certainly see that, in the teams that I manage. Not that we are, we can hire and we are hiring as a company, but we're also saying, how can we use AI to be better and more efficient, more scalable, the things that we're doing. And I'm implementing a couple different AI solutions in how we do diligence and how we do B2B customer support, as we think about accelerating both the self-serve capabilities, the accuracy, the efficiency, and scalability. So I think that's definitely playing out across not just technology companies, but a lot of kind of more legacy businesses that don't just want to keep growing on headcount. So as we look through into 2025, we're already a quarter in to the year, so we've got 3 quarters left. What piece of advice would you offer to either lenders, financial institutions, to think about navigating what's ahead this year?
Yeah, I mean, I think this year in particular, all I would say, and it's the advice that I try to take myself all the time, which is stay humble, and don't cling too strictly to your assumptions, because I think in this kind of environment, things can change very rapidly in one direction or the other, either for the negative or for the positive even.
Great. Yeah. And I think we even saw that reflected in the questions we'd prepared for this session, where had a much more robust, yay, go economy. And now it's a little more uncertainty coming into the year. Well, anyways, Joseph, really appreciate you having on the podcast again. Thanks for taking time to share your insights with us.
Absolutely. Thank you, Lynn.